As investors, we all want to maximize our returns and minimize our risk. Otherwise, we probably wouldn't be investing. I mean, who wants to lose money? There are ways to easily minimize risk when it comes to investing, and the most important step to reduce risk is to diversify your investment portfolio. Why? Well, concentrating investments means concentrating your risk. In this video, I'm presenting you some popular and proven concepts of diversification that can give you food for thought, or you can even use them as guidelines when it comes to building your own portfolio. And then we'll also look at some concrete examples to see how it could be done. But remember, these are examples only. This is not investing advice. If this is a little too long for you, then decide whether you want to see the strategies and the concepts, that's the first part, or whether you just want to see the examples, then just skip to the other part. That's totally fine. And now enjoy the video. Let's start with looking at the most common risks and diversification strategies on how to reduce them. As I've mentioned before, there's country risk, where you are exposed to one country and their economic and political prosperity. You are risking a lot if that country ever goes through economic tough times, like many countries are doing at some point, or even a war broke out. You can simply reduce the risk by investing across several countries and regions of the world. Then there are industry risks, and we have seen that with aviation in past years, for example. With COVID and the travel restrictions, any stocks that had to do with aviation plummeted, and they have still not recovered completely. So an easy way to lessen the risk there is to just invest across many industries. The same goes with company size. You want to be invested in different companies, especially with different company sizes, to reduce company risk. Another and very important way to reduce risk is to spread your investments across different asset classes. The different types of investments inheritably have different levels of risks involved. Stocks or funds that consist of stocks always have a higher risk involved than bonds, for example, where the interest is fixed from the beginning, the term is fixed in the beginning, and you will get your money back at the end of the term unless the government or the company that issued the bond goes bankrupt in that time. Bonds even have investment grades that classify their default risk. So with bonds, it's very easy for you to determine the level of risk involved. Many classic diversification strategies only advise on the distribution between bonds and stocks. One widespread rule of thumb for a balanced portfolio, for example, is 60% stocks and 40% bonds. However, there are other asset classes like commodities, for example, or short-term money market securities or cash. It is very important that you always keep some kind of cash at hand, which is your emergency fund. And then apart from your emergency fund, you can choose whether you want to keep more money in cash or not, depending on your risk type. The reason you want to invest across different asset classes is because in an economic downturn, for example, the asset classes react differently. In a bear market, stocks could lose 20% of their value, for example, while bonds and other investments could stay at the same level or even go up. Let's summarize. If you want to properly diversify your portfolio, you should buy investments from different countries, different industries, and also different company sizes. On the other hand, you should diversify by having different types of assets and not just stocks, for example. Let's now look at some well-proven concepts when it comes to diversification. The first one is the stock versus bond ratio. I have already mentioned the 60-40 portfolio, which is a very popular choice for the average investor. Deciding the split between stocks and bonds has a lot to do with your personal risk profile. An aggressive investor might want to have 80% or even 90% in stocks and only 20 or 10% in bonds, while a more conservative investor might prefer 80% in bonds and 20% in stocks. There is a strategy called Lifecycle investing, which says that depending on which stage you're at in life, you will want different distributions of stocks versus bonds because your risk preference will change over the years. When you're in your 20s, for example, you still have a long time to go until retirement, so you can choose riskier investments that have the potential to make you a lot of money, bring in great returns, because you still have time to make up for potential losses, for example. If, on the other hand, you're only 5 years from retirement, you want your money in much safer options because you don't have the time to recover from a full-on bear market, for example, and an overall loss of 30% in your investment portfolio. So life cycle investing means that you change your asset allocation as you age. The older you get, you shift your investments to more safer options to protect your wealth. There's an easy formula to decide how to distribute your investments. You can take your age and subtract that from 100, and that is the amount of stocks that you should have in your portfolio. So for example, as a 20-year-old, you could keep 80% of your portfolio in stocks and 20% in bonds, while a 60-year-old could have 40% in stocks and 60% in bonds. When it comes to diversification, there's one more general rule of thumb that I think is very important, and it says that we should not have more than 5 or 10% of all our investment portfolio in one specific option or one specific stock, for example. Obviously, you can choose to aggressively buy into one particular stock that you think is going to make you a lot of money, but if you want to reduce your risk of losing money, then have that rule of thumb in mind. Let's move on and take a look at how diversification can actually look like in your portfolio, and let's look at some examples. The examples I've chosen are some that I have seen over and over again when it comes to investing. Let's start with the easiest one of all. If you want to have a diversified stock portfolio, you can also achieve that by just investing in one fund that covers the entire world, different countries, different industries, and different company sizes. You all have probably heard about the MSCI World, which everyone is talking about, but be aware, even though it's highly recommended, it does not diversify entirely because it only includes countries of the developed world, none of the emerging markets. So if you want to include emerging markets as well and just have a proper diversification, then for example, there's the MSCI World All Country Index or the FTSE All World. There are several indexes that cover emerging markets, developed world, and all different industries and companies. The next one is a little variance to what we have just seen, and it's the 70-30 portfolio, which is highly recommended by the German finance blogger industry. And it is 70% developed world and 30% emerging markets. So with that strategy, you actually buy into two separate funds. One, like the MSCI World, for example, which is just for the developed world, and then another one which is solely emerging market. And by doing that in two funds, you can choose the ratio that you'd like to have in your investment portfolio. And the 70-30 is something that's recommended compared to the MSCI All Country Index, which has around 10% of emerging markets included. This strategy actually focuses more on emerging markets and has more of its allocation towards emerging markets. For last week's video, I've looked through many studies that analyze the performance of funds, and I have actually stumbled across some that analyze the performance of emerging market funds. So let's briefly look at what these studies found. So emerging market mutual funds would outperform the MSCI index and the S&P 500 index. This one from 2011 also showed that emerging market equity funds overperformed compared to US equity funds. So as we have seen from research, it is a great idea to include emerging markets in your investment portfolio, whether that be by a fund that includes it already or with a strategy like the 70-30. These first two strategies have only looked at the stocks and equity funds in your portfolio, so only the stock section. Obviously, if you're just starting out investing, that's a wonderful way to diversify your portfolio. But if you want to take it one step further, now you can decide whether you want to include things like commodities or real estate in your portfolio. For example, there are real estate funds, there are commodity funds, so you can mix one or two of these in with your portfolio to further diversify. The same goes for bonds. There are bond funds that only invest in bonds, so you don't have to invest in one specific bond only. You can just choose a fund and invest in several. The last example that I have for you is Ray Dalios All Weather Portfolio, which is probably the most complete strategy when it comes to diversification because it includes the other options as well and not just stocks. As we have seen in my last video, Ray Dalio is an impressive fund manager and has achieved an annual return of around 21% before fees over a period of years. So he really knows what he's doing, and he has shared his all-weather portfolio that he recommends with the actual percentages of allocation. So let's look at it. The all-weather portfolio has 30% stocks, 55% bonds, and 15% commodities. For the bond section, he recommends to have around 15% of intermediate terms, which would be 7 to 10 years, and the rest of it, 40% in long-term bonds, which would be 20 to 25 years. And then the commodities are split between gold and other commodities, so each of them around 7.5% of the portfolio. Now you may ask yourself, why is he recommending only such a small percentage of stocks? Well, he says stocks are about 3 times more risky than bonds. So if you have a 50-50 distribution, for example, in your portfolio, 50% stocks, 50% bonds, because of the different risk profiles that they have, you actually have around 95% of stock risk and only 5% in bond risk. So this is something that he says we should have in mind. So why is this portfolio called the all-season portfolio? Well, it is built to do well in all kinds of seasons of the economy. Let's now look at the performance of the all-season portfolio versus the S&P 500. When we look at the growth in a 30-year period, we see that the all-seasons portfolio has made an annual 9.72% net of fees, so the fees already deducted, while the S&P 500 in the same period has made an annual return of 9.83%, but this is with fees. So we have to deduct around 0.02% to 0.5% of fees that would be necessary to have an S&P 500 fund. So the return is pretty similar, but when it comes to losses, there's a huge difference. In a 75-year period, the largest single loss that the S&P 500 had was 43.3%, while the all-seasons portfolio only had a loss of 3.93%. The total average loss in that period was minus 11.4% for the S&P 500 and minus 1.63% only for the all-season portfolio. And that is due to the fact that in these 75 years, the all-season portfolio has only lost money 10 times, while the S&P has lost money 18 times. As we have seen, there are many different diversification strategies with different levels of complexity, I would say. Some of these you can already include now, even if you have just started out with investing. Some others, maybe you want to keep adding them and including them in your portfolio as you invest more. These were just 4 examples of hundreds or thousands of strategies that you could do when it comes to diversifying. A very important thing to have in mind when it comes to diversification is to rebalance your portfolio. So once you have decided on what you want to do with the diversification, take the time to annually look at your portfolio and look at your distribution. How have you allocated your investments in that year? And then you can adjust accordingly. I want to finish this video with the advice of Benjamin Graham, who says that we should have adequate but not excessive diversification. So if you find yourself lost in details, overanalyzing or overwhelmed by all the diversification options, then choose a simple approach and start with that. So that's the end of the video. If you've made it to that point, I know that you are really interested and you want to learn more about investing. So I will link my investing playlist if you want some more videos on that. If you have further questions about investing or other topics you'd like me to address in a future video, then please let me know in the comments down below. I hope this video was helpful to you, and I'll see you in my next video.